Got another, I think, very interesting session. It's called Making Money, Making Markets. And my goal with this session was to explore the concept of marketplaces. And that's something that's very interesting to me because I think data publishers in particular are, in many cases, in a really good position in terms of thinking about operating a marketplace of their own because they're already, like many media companies, in the center of a vertical market. They're established brands, they're neutral players, and I think it's also fascinating that they know a lot of the players, if not all the players in the market on both the buy side and the sell side, and that's an interesting sort of head start. But when I talk to publishers about marketplaces, that often the first thing I hear is, oh, you mean like eBay or Craigslist or something like that. And I guess I have a slightly more expansive view of marketplaces, and that's why I'm really happy that we've got two speakers today that I think will give you a different perspective on what a marketplace could be, because a marketplace isn't always just buying and selling used equipment or items like that, but it can be a whole different way to think about your business. It could be a way that lets you accumulate information in different ways, perhaps build a stronger community among your users, lots of interesting angles. So today we've got Dave Jeffords, who's with DealVector, and we've got David Peterson, who's with CompStak, the two Davids. I felt what we do to kick this off because it's important to understand their businesses, to understand where they're coming from and the comments they're going to make today. So maybe if David Warren wants to kick off, and then we'll talk to David too.
Sure. Hi everyone. I'm the David from CompStak. And are we going to do the slides? Should I go through them?
Yeah,
or?
You need the clicker.
Yeah, I guess so. So how many of you guys have experience with commercial real estate data? Anybody? A few? Okay. So I'll give you guys some background just on the world that CompStak kind of lives in. So a quick explanation of what CompStak is. We crowdsource commercial real estate data, specifically lease transactions. So completed lease transactions are what people in the industry call comps. And why do we actually do this? Well, we believe that better data leads to better decisions, better deals for the brokers and the investors and the tenants. So we actually have users from all of the major brokerage firms in the country on our platform, using it every single day in 12 different markets right now, soon to be many more than that. And the question is, why do they actually get on the site? Why do they care? And that's because we know what these people are paying for their lease. Not only do we know what they're paying, but we actually know all of the details of that deal. So we know what floor they're on, what their rent schedule is, what the tenant improvement allowance is, all these specific details to commercial real estate transactions that are really valuable. Now the question is, how do we actually get that data? So I'm going to take a step back and explain to you how the system works. So the CEO of and founder of CompStak, Mike Mandel, he was a broker in Manhattan for about 6 years. And what he found is that the way that people exchanged data was very inefficient. And it was really like this. It was, you call up a buddy and you ask if they have any information that you might need. If you don't call them, you email them. You see them at a bar and you write it down on a cocktail napkin. This is actually how the data is exchanged every day. So Mike kind of thought there's got to be a better way. Maybe we can take this process of sharing data, bring it online, make it a little bit more efficient. And so the way that it works is with CompStak, you can share the information that you have in exchange for credits, use those credits to unlock the information you need off the site. It's kind of a classic give-to-get model, just bringing that to commercial real estate. So what you'll see is, when let's say one broker has some deals, another broker has another. Once we get enough actually sharing in the system, this is what we've proven out in our 12 markets so far, we end up getting a comprehensive view of what's going on in the market. So we know what is actually being paid for in all these different buildings. We can track trends over time. And this is very valuable to private equity funds, asset managers, banks, lenders. That's how we end up making money, is we sell subscription access to those types of folks. Just some of our customers are these types of companies. So both massive landlords as well as Wells Fargo, who's using it for lending and underwriting loans. Just to give you guys some background, it's hard to read this white. This is where we are right now. So a lot of the cities you might expect, a lot of the biggest cities in the U.S., and where we're expanding, a lot more peripheral markets, and eventually global. So that's a quick background into how our model works and why we're doing what we're doing.
Great. David, DealVector?
Yeah, no, it's great. It's really interesting to see his presentation because it resonates in many ways with what we do, and yet there are some important differences. So I think at the highest level, the way to think about what DealVector does is we're a platform that allows for the registration and compilation of information around securities holding data, which is, the way we like to describe it is the largest blockaded information set that exists in the Google era. So the assets that are amenable to our service, our core assets are sort of on the order of 20 trillion, and from a more expansive view, could be upwards of 100 trillion of assets are the kinds of assets that make sense for our users to want to use our system, and yet, in which the information is very difficult to find under the current system. So what do I mean? Mostly what I'm talking about is the bond market and areas of real inside baseball, like structured credit, who owns what, how do you find that holder. This is the kind of information that most people, when you start to talk about it, people assume that information is available, that it's out there. But in fact, it's really much more sort of like an iceberg, where there's about 10% of the data that's publicly disclosed by holders like mutual funds and other investors, but the great bulk of that information is hidden. And so what we have is a similar sort of give-to-get model to what David was describing for his business, except our information is around the holder information, and particularly with respect to the bond market. So another way to think about it is that this is sort of like really inside baseball stuff for inside baseball in the largest stadium you can imagine, because that asset base is on the order of 1.5 times global GDP. So really large numbers of assets where there's high stakes, but really artisanal, old school, calling around, picking up the phone, having drinks with guys in order to figure out who owns what, so that I can either buy it or assemble voting coalitions together to get to, if I need another 20 million votes to call a $500 million deal, that's the kind of thing that people use our system for. And so the give-to-get model really resonates with us. There's a sort of an additional layer of sensitivity to the fact that most of our users are professional investors with that they're very highly regulated, that have a lot of fiduciary duties that they need to be sensitive to. So, for example, a big hedge fund doesn't want to just go out and post his portfolio in a way that's searchable by everybody. So what our system does is it sort of, in its architecting, accommodates a lot of those sensitivities, and ultimately what our users do is they escrow the information in a way that's not searchable, that's not findable by anybody else, but that makes it available for matching with other users when they want to find it, so when they want to find each other. So that's essentially what we do. And like I said, there's a lot of resonances to what David One was describing for his business, and I think we have a lot of the same customers, but we're coming at them from very different angles.
Yeah, that customer overlap is just fascinating, because you wouldn't see that on the surface. But real estate, I guess, is behind everything these days. So, on the CompStak model, I think you mentioned in your description that part of what you did was you were selling the information off to pension funds and investors and things like that. Mm-hmm. I mean, that goes to probably one of the core questions I have for both of you, really, is in establishing these types of marketplaces. I would think the trust would be fundamental to that. And how do you establish that trust, especially starting from scratch, and how do you show people that you're serious about it, and particularly one where you're selling the information off to third parties? Does that make it harder, or does that make it easier? I'm just kind of curious about the dynamics of trust in building a marketplace.
Sure, yeah. I feel like there's two questions there. The first is, how do you establish trust with your trust with your users that they're going to be giving you data that eventually you're going to profit from. So that's one part of it. And the way we get around that is we're really in the broker's court as far as we're concerned. This is something, the way that they're trading data is inefficient. We're able to give them a way to trade data in essentially the same way. We're just bringing it online. They're able to do more deals, so they're able to do deals faster, and they're able to actually do deals with better data, so the deals that they're doing are better. They're able to provide for their tenants and actually their clients better. So I think in that regard, they trust us because they realize that we're providing them a service. But I think for both, honestly, cutting through it all, for both them and for the investors, what really helps them trust you is when you pull up a deal that they know the details of and that they're interested in, and you pull it up and you have the exact details that they know. And that's how we win. Ultimately, that's how we win all of our deals. Is we show them their build. This investor, we show them their building, and we have every single tenant in there and all of the details, and they know that it's right. So that's probably what it really comes down to, is the proof of the pudding is in the eating, I think.
Interesting.
Yeah, the trust issue is an opportunity for us in the sense that, there was this whole scandal with Bloomberg where they had gone out and it turns out that they were scanning and using for their news service a lot of the proprietary email information that their users were providing the system, and that's something that from which they're still recovering. So in a sense, we saw that as an opportunity, but is also a challenge to a startup like us. But we did a couple of things. One was that in part for that trust issue, but in part also just to have a critical mass of participants at the outset, so that there's a there. The sound of one hand clapping is not very exciting, but what we did was we essentially got 25 institutions, all sort of like $1 billion plus assets under management, to all sign up simultaneously, and also to work with us in developing our terms and conditions, so that they had a sense of ownership in the process and participation in the actual format for how they would be interacting with other users and what the rules of the road would be. And I think that's actually really important consideration when you're building a market-oriented platform in any industry. One of the big value adds is that you are smoothing those rules of the road. So if you go around and you talk to 5 important customers and you really spend a lot of time with them working out what's going to be important to them in terms of the terms and conditions, but also how the system works and what would be useful to them, and you lay that out in a very sort of diligent way with a few guys that understand the market, then all of a sudden you can be teaching the other 100 guys that are your next conversations. And then that's really what it becomes very sticky about the platform, is that, okay, well, if I want to trade, then everything is very clearly laid out and I understand what the terms and conditions are, and so I become comfortable with it. And so that becomes ultimately a legacy moat for you against new entrants, as people are accustomed to the system and they are comfortable, and if they've had a hand in helping develop it in the first place, well, then their trust level is very high. So all of that, I think, at the front end matters a lot. And then Dave's point was really exactly right. In the fullness of time, once you get past that starting gate, you have to be able to deliver and add value to your customers, and then they really trust you.
Right. That does make sense. I think you both really could be said to have that give to get model operational. Could you each of you talk a little bit more about the revenue side of that? Obviously, swapping stuff back and forth is fun, but doesn't generate a lot of revenue by itself. Where exactly does the revenue component come in each of your systems?
Sure. Yeah. So with us, the plan is never to make money on the give to get side of our marketplace. So brokers, appraisers, researchers, these folks are always going to be free users. They can always use the platform to share data, to get data. We really want to make money by selling subscription access and analytics, and kind of build an analytical suite for investors and lenders, the people who are making large monetary decisions based on this data, we want to provide them with the tools to make those decisions better. And we found that, you saw the customer list, they crave this data because it's really hard for them to get.
Right.
So I think long term, that's the way we're going to make our money, and it lets us also not bite the hand that feeds us. We're not going to charge the brokers who have given us this data over the years.
Right. So am I correct that when you're selling the data, it's only in aggregate form then? So that can they drill down to a particular lease or building? Or?
They can drill down. Okay. So they're getting, it depends on who's buying it and how the deal is structured. But some are getting essentially an API dump of deals, and others are buying it more in aggregate because they want to compare building profiles overall, something like that. But we have the whole range.
Got it.
Yeah.
Yeah, again, there are lots of resonances to what we do. We have that always free, almost like a freemium model, right? The give to get portion of our network is very easy and seamless. You can onboard in 2 minutes, and you can contribute data in 2 minutes, and then you can start trying to utilize that give to get model in 2 minutes. But what we find is that with that sort of beachhead, we can then get inside the workflow of people that are participating in this very large and yet really artisanal market. So, for example, we have $10 billion a week in bid lists that come through our system, and the way the legacy market works is all that's really just mediated via emails. And every user is sort of coming up with his own system for ingesting that information and processing it and then turning it around and trying to be effective in processing what may be bids on 100 bonds. How do I decide which ones to work on? How do I decide which ones I have the best shot at, or that are most interesting to me or most similar to the ones that I already have? And so what we're finding is that using that beachhead and then getting deeper inside of each client is the way to start to monetize that stuff. So we have this workflow automation stuff, a compliance module for as you might imagine, a lot of these big institutions, they have a lot of sensitivities around communications now and how things are going out, or are they going to be on the headline of the Wall Street Journal tomorrow or not? And so our compliance systems actually. For starters, we'll do everything that any other compliance module for email or other systems would do, but then we also have some additional tools that give them additional layers of comfort in terms of being able to be more proactive. So all of that, I think as people are considering, well, how do I make money in markets, or how do I go about, exploring an opportunity in what I do, I think the most important thing is to really get inside the workflow of your customers, and every little thing that may seem to be really trivial that can save them time, or that will make them slightly more efficient in their day job, becomes just another stickiness that helps you to keep them and then to expand your market. And so that's sort of what we do. Is we have the beachhead of the free service that gets us the data like you do, and then we start to go deep into different verticals.
Interesting. You mentioned compliance, which I think is a great question for both of you, because my sense, at least of the commercial real estate agent industry, is that the brokers are starting to realize the value of some of the information that flows through their thing. Does an individual broker need permission from the agency he works for? Does your individual need permission from the bank or investment company he works for, or do they come in as individuals?
Yeah, that's a good question. We have users that are just individuals. We also have companies come on, as a company, and they all kind of manage the data flow as a company, and it's centralized. But I think CompStak was really built as a tool for individual brokers, so there isn't a rule. You don't have to come on as a company. We kind of live in a weird gray area in the world of commercial real estate, because while this data is shared very, very widely between brokers and appraisers and everybody else, essentially all the time, a lot of the data is a lot of these individuals are bound by confidentiality clauses or NDAs or whatever if they were party to the lease directly. So it's kind of a strange space because we're mimicking something that they're already doing online, offline, online. But a lot of times what they have been doing for decades is actually breaking a clause in some contract. So generally our rule of thumb here is that you shouldn't be sharing something you're not allowed to share. But that's that's the confidentiality issue itself. That's really where it comes up. And the reason we bring on entire companies is because then they can manage that flow of data, and they know that they're not sharing deals that they're not allowed to share, and that lets them actually control the risk.
Interesting. Yeah. I guess compliance is your least favorite word.
Well, I mean, now that we've got a system in place that people like and are comfortable using, it's a competitive advantage for us. To your initial question, I think that there are differing levels of sensitivity. And again, like CompStak, we allow both individuals and institutions to register and to use our system, which I think, again, trying to just think about lessons for making markets or making market-driven platforms, I think is important. And it was an intentional decision that we made at inception because of the lessons of my co-founder, a fellow named Mike Manning, who came out of the commercial real estate world many moons ago, and there was a history there of competition where I have to remember which business was which, but one business basically said, we're only going to do institutional sales. I'm going to get 1,000 people at once. I'm going to get IBM or nothing. And another business basically said, well, we're going to build it from the ground up, and individuals at, let's say, IBM are allowed to join our system. And you never necessarily know which is going to win when you're starting to exploit a new market opportunity. In that case, it was the organically grown one that gained a lot more traction and then therefore was able to get more funding and then was able to then later get over the institutional humps to make those big sales. So I think the flexibility is strategically important and tactically not that hard. Everybody has to sign the same terms and conditions. Mm-hmm. An institutional sale for us tends to be it's just a longer lead time. And so I think those are some of the balancing issues. There's also, the whole regulatory landscape for us, getting just sort of like where I think you were going with the compliance stuff, is interesting because I think there's been a real shift in the culture, and probably a lot of you have sensed this as well. But 4 or 5 years ago, I think there was just a different comfort level with putting information out on the web. I think it was a different mindset. Information was still considered to be proprietary and not to be unlocked into the cloud. And paradoxically, even as the NSA and we've learned that the NSA and these other entities may get access to that stuff, the comfort level has still increased. And so that is starting to seep into the regulatory climate. And in finance, especially in what we do, it's gone even further. It's become sort of the mission is to improve transparency in the markets that we're dealing in. Because to a large degree, the lack of transparency is seen as having been part and parcel of what caused the financial crisis of 2008. If there had been better transparency of information, if there had been better communications, then things might not have gotten as far extreme as they did to eventually drive us off the cliff. So what we find is that the stance of regulators has become much more friendly, and the stance of the tough guys at our clients, the legal officers and everything, has also become more open-minded. And so it'll be interesting to see if that continues, or if they'll start to, at some point we'll reach the level of comfort and then we'll start to pull back. But I think at this point we're still in a mode where transparency of any types is being viewed as a positive experimentation in software as a service generally. And so we're finding that there was much less pushback than we expected at inception.
That's interesting, and I love the juxtaposition because you're pushing transparency, which you obviously are. It's helping people get a better sense of what's going on in the marketplace, but you're doing it through an anonymous matching service.
Well, exactly.
It's kind of cool.
Right. And I think what's important for us is we don't then try to control the relationship. So there are lots of bond trading platforms. There's where it's possible to go for certain sectors of the bond market to go and to get liquidity on a web-based sort of application or client side with web sort of infrastructure. But for what we're doing, we don't need to remain in the middle. So our mission is to really fill that gap that exists in the infrastructure of finance. And it's probably just worth digressing really quickly here, but essentially the way the system of finance works is there's this thing called the street name system, which means that the assets, the stocks that you own at, let's say, Fidelity, say you own Microsoft stock, you actually are not, in a formal legal sense, the owner of that asset. You may think that you own Microsoft stock, but in fact what you own is a beneficial interest that the broker, the custodian, must honor with respect to those shares. And the reason it works that way is that in way back in the 60s and 70s, everything used to be done by paper. And if I was the CFO of IBM, I had a register where I could see all of the shareholders that I had, and I could see all of the bondholders that I had, and it was literally a piece of paper that was run across the street back and forth to evidence the fact of that ownership. This quickly became overwhelmed as volumes began to increase, and there was sort of a mini global financial crisis in the late 60s where a lot of firms went under because they couldn't keep up with the processing of these trades. And so they put in place the modern system architecture of finance, which is called DTC, which essentially means that everything is done by electronic ledger entry. But that system is very closed and it's owned by a few banks at the center of that structure, and in some ways it works really, really well. So for example, there's something like $2 quadrillion of securities that are settled every year very cleanly with almost no errors. When there are errors, they're fixed very quickly. And the reason that it happens that way is because we don't actually trade $2 quadrillion worth of shares. Everyone that's at Fidelity nets out that day. So if there's 100,000 shares of Microsoft that trade and they net to 1,000 shares of changed size within Fidelity, then Fidelity says, okay, I had a small amount of shares that changed, and Goldman says, I had a small amount of shares that changed, and another institution says, I had a small amount of shares, and they all just will do small ledger entries, and so it's ledgering all the way down, and that works really, really well. But the problem is that it divorces that information of who owns what from the issuer, and it also makes it impossible for one owner of an asset to communicate and find another owner of the asset. In fact, they have no standing to do that whatsoever. And so what is a really arcane sort of phenomenon has big impacts because it ends up vesting a lot of power in the brokers at the center of the whole structure, and all the people in the periphery sort of don't realize that it's to their detriment. And so what our system does is it sort of equalizes that playing field, and it makes that information mutually available through another channel when our users opt in. And so that's where we sort of, in the biggest picture, fit into the give to get model. That's the hole that we're trying to fix, and we're not trying to be a broker. We're not trying to compete with another online transactional platform. So I guess like a very clear focus on what you're trying to do and which part of the value chain your market, if you choose to create one, is filling is the other thing that I would say is really important, because there are lots and lots and lots of bond platforms. Everyone who says the bond market is sucks thinks to themselves, I'm going to create a bond trading platform. I'm going to go in and I'm going to have a better bond trading platform. And there's just littered with companies that have tried and failed because there's already a lot of bond trading platforms. So what we said was, we're going to try to do just that thing that's missing and to really focus like a laser on that. And I think you guys did the same thing, essentially, right? You found one thing that was really missing. It probably came out of one of your founders' pain points, something that he experienced personally. And, by drilling down through that, then you're able to eventually, once you create your geographic footprint, you'll probably be able to go deeper with all of your clients.
Yeah, absolutely.
That's interesting. But, that conversation around platforms is a good one because it's got to be tempting at some level, and certainly all the rage these days, to whatever you do to declare it a platform and say, what else can I load on here? Especially when you're doing something that, no matter how successful it is incredibly narrow. You say, if I had a little more stuff, I could get more people, I could do more things. Your advice sounds like stick to the knitting, or maybe platform ambitions down the road.
For me, it was all about the pain point. So I was trading these markets, and I sort of personally figured out that I had this problem, and I didn't quite know how to solve it. And then in the fullness of time, we realized it was a more generalizable problem that maybe merited an entire business. So if you can really figure out like what you would like to see in the world, people always say this to entrepreneurs, you should figure out, what you would like to have as a product, and then make that your product, something that you've already validated either out of your professional experience or otherwise.
That's interesting.
And I think the way that we've gotten around that, like you said, David, we're laser focused as well on a very specific type of model, a very specific type of way of collecting data, and a very specific piece of data, just completed lease transactions. The way that we've been able to kind of increase our stickiness and get users really excited about this one piece of somewhat, arcane data is we realize that different people use different parts of a lease for different things. So we can kind of create different features within the product that speak to a specific person who's doing a specific part of the deal, and say, of the 30 fields of a lease, you actually only need these 3 for what you're doing right now. We're going to let you just get those 3, and we're going to help you with that workflow. And we do the same thing for multiple different things that people do every day, and now that's how you have people using it every single day, because it really is solving a very specific problem. And it just so happens we could solve that problem with the same piece of data, just kind of chopped it up in different ways.
Interesting.
Yeah.
I mean, you're both relatively young companies, and one of the questions that is on my mind is about branding and how do you get yourself established in the marketplace and start to build that trust. I mean, would you have been able to grow faster or more assuredly if you had a known brand in your industry behind you, or did you benefit from independence or from being a startup?
I think we probably benefited from independence, and that's because the major players in commercial real estate, everybody's very, very competitive. So the minute that you think that one company has some stake in this small service, nobody else is going to use it because they're just going to, and people in commercial real estate have had some bad experiences with players coming in, buying everybody up, and then making everybody pay and increasing the prices every year. That type of world happens. That's happened a lot. So I think our independence was a huge benefit to us.
Interesting.
Yeah, ditto. There's definitely, being Switzerland is a strategic advantage for a startup, right?
Yeah.
To come in, so it's important to position yourself that way. And I would say, in fact, to not be affiliated with any particular player, because there'll be a temptation to get backed by someone who can take you from step 1 to step 4.
Yeah.
But there's a big trade-off there, because then you cut off a lot of branches of the tree of your future path. And so that's been our view so far, and I don't see anything to change it.
Yeah, absolutely. Same with us. Same decision. Yeah.
I'd like to open up to questions, but I'm going to squeeze in one more first, which is, could you give us some lessons learned, things along the way you might not do again if you had them?
Oh, jeez. Here, you start.
Yeah, always go first. Well, let's see, lessons learned.
Anything you wouldn't do again, or?
Yeah. I mean, I'll say something. So the biggest challenge for us is that it's and we kind of both mentioned this already, it's a chicken or the egg problem. You need to have enough data to become a legitimate service that people want, but how do you become a legitimate service without enough data? That's a constant problem, and that's, we're expanding to new markets. It's a problem in each new market as well. This isn't a problem that just disappears after you've solved it the first time. So I think a good lesson that we could have learned earlier is figuring out how to, number one, don't get into the business at all if you can't solve that problem up front, if you don't have the right contacts to solve that problem initially. And then immediately, once you get started, start thinking about who the strategic players are in each market that will help you solve that problem, who those champions are. And, we've gotten there, and we were able to solve it in Manhattan where we started, but it took us a while. There was a moment where we kind of got too big for our britches, I think, and just thought, look, we made it work in Manhattan, it'll work anywhere now. That's totally not true, right? You need to rebuild it every single time.
Yeah, and I think that I say that that we set out to be Switzerland, and then that worked. In a sense, though, we were a little bit one-sided in that our initial mission was to connect what we call the buy side, the investor side of the market, which is, with that phrase, is seen as in opposition to the sell side. And in fact, when we really started to court the sell side players, that's when the picture really became complete. So I would say that we should have been even more Switzerlandy earlier than we were. Good.